Hi there, welcome to Market Call. Andrew Moffs is our guest on the show today, Senior Vice President, Portfolio Manager at Vision Capital, and he'll take your tweets, your calls and your emails on real estate stocks, REITs and real estate equities. Call us toll free, 1-855-326-6266, or email us, marketcall@bnnbloomberg.ca. Andrew, thanks for joining us again.
Very much for having me today.
Always love having you on the show because you give us more detailed insight into real estate. It looks as though interest rates are going to turn up, who knows when. How is that playing out in the sentiment among real estate investors right now?
Yeah, the sentiment continues to be very positive. And the answer is to the question, why would they be in the face of rising interest rates possibly, is because we're seeing inflation, and inflation is real. Inflation is translating into rent growth, and that's really the valuation, the key part of the valuation equation for real estate. You're seeing very high new lease rent growth in places like the U.S. Sunbelt and apartments. You're seeing it in the single-family home rental sector. You're seeing it in the industrial sector. So those that own properties that are well capitalized, meaning they've taken this period of time of low interest rates to go out, get new mortgages, they're well positioned and in fact have dry powder to take advantage of what will be an increased rent environment for those sectors that have pricing power.
Typically, in periods of inflation, real estate outperforms?
Absolutely. Real estate is, because of replacement costs, what you find is in periods of inflation, real estate is able to keep its value. It is a store of value because, like I said, as rents go up, the values go higher, as well as the replacement aspect of it. In order to rebuild these properties, it costs more. In simple terms, it just costs more money. So as replacement costs go higher, so does inflation.
And we were going to get into this, but are you seeing value in retail real estate right now?
We are actually. We're seeing it on the grocery anchored shopping side. That's really our focus at Vision today, is more of that necessity based shopping, where the pandemic really proved the resilience of this asset class. And it's not necessarily just our opinion. We're seeing it in the values in the private market. We're seeing institutions like Blackstone for the first time get back into the shopping center space in the United States. And that bodes well for some of the positions that we own at Vision.
Okay, we are going to be talking real estate with Andrew Moffs today on Market Call. Andrew is Senior Vice President, Portfolio Manager at Vision Capital. So it's REITs, real estate stocks, property-related equities, 1-855-326-6266. We'll kick off with an email from Sergio. Sergio is asking about Storage Vault Canada, SVI. What's your opinion?
Storage Vault's one of our favorite names at Vision. It operates in the self-storage industry. It's the largest operator in Canada. This is a great sector. It has constantly proven itself as being recession resilient. It benefits from all the different life events that occur, and so thus it's not really tied to the economic cycle. Of course, those life events are move in, move out, death, divorce, dislocation, disruption, a disaster, all the Ds you can think of. What we like about Storage Vault specifically is that this is a high growth story, and what you couple that, so very strong internal cash flow, order of magnitude 25% same store NOI growth. That's what they achieved in the third quarter. You then look at the valuation, and we look to the United States, where we've seen quite a few very large portfolios trade recently. These multiple portfolios have traded at rates of ingoing yields of around 3.5%. If I apply that to Storage Vault, I have a stock worth well north of $9. So you have this combination of great internal growth, great external growth, recession resilient. This is a stock we continue to own at Vision.
Oh, okay. That's interesting. Yeah. Recession resistant. Yeah, I guess people, if they have to move out of their house, or that happens all the time. And so they are going to need a locker.
Absolutely. And what people also forget about is the portion of the business that is not just individual consumers, it's business owners. Mm-hmm. And so about anywhere from 10 to 20% of the business can be those that need to store, whether it's the person that does, lawn landscaping in the summer, snow tires or shoveling snow in the winter, pharmaceuticals, companies that have agents in the field. You have elements of the business that will always be there no matter what the economic environment is.
Okay, we have a caller from Montreal. Nick is kicking us off this week. Go ahead, please.
Good afternoon. Thank you for taking my call. I'd just like your opinion on Slate Grocery, if you can comment on its balance sheet, dividend, and do you see this company growing, considering it's a small company? I'll hang up and listen to your opinion. Thank you. Have a good day. Bye.
Thanks.
So Slate Grocery is a REIT that trades on the TSX with the majority, well, actually all its assets in the United States. Just by definition of its name, it owns grocery-anchored shopping centers, which is, as I alluded to at the outset of the show, a sector we like at Vision. The benefit, of course, is that when you own small centers that are leased to the dominant or number 2 grocer in any market, you'll benefit from the traffic that has to occur as people need to go to the grocery store. Of course, a lot of grocery shopping has gone online, but these centers benefit from those that do have to go to the grocery store and their inline tenants, like the pharmacy or dry cleaner, benefit as a result. Slate Grocery, they've done a good job in terms of growing the portfolio. They took down a very large portfolio earlier this year and did an equity deal in order to finance it. So I think the balance sheet is fine. I think the distribution yield is safe. They are going to go through, like any REIT, go through a bit of a digestion phase when you do a very large acquisition. So for the moment, it's probably a safe hold. I don't see anything one way or the other in terms of the outlook. I think it's pretty safe and stable at this point.
Okay, let's head, thanks for that question, Nick. Let's head to Chilliwack. We've got Andre, one of our regulars. Andre, before we get going, if you don't mind me asking, what about in Chilliwack? What kind of impact have you seen from the rains and the floods?
Good morning, Andrew. It's quite serious. The roads are closed. It's sort of what you see in the news. I'm very fortunate I work in town, so I'm okay. But my heart goes out to all the farmers, the ones that live in the flood area. It's serious.
I know, beyond disturbing, obviously. Andre, what's your question, please?
Yeah, no, thanks, Andrew. My question is on granite. I very much enjoy the sector. I own Tricon, and I'd like to add with granite. I'd like to, can you give me a comparison on how it trades with its peers, and would you buy it and hold it long term? Thank you. Have a good day, you guys.
Thanks. Granite REIT.
So Granite REIT is a name we own in our fund at Vision. We would own it long term. What we like about this company is that it owns industrial properties across North America as well as in Europe. Europe is probably the one continent that's a little behind in terms of industrial valuations. I mean, we've seen record pricing here in Canada and record pricing in the United States. Europe is a little bit behind, and we think that it's on track to garner what should be record pricing there as well in terms of both rents and valuation. Granite is just a very stable company with a tremendous balance sheet. They've always operated with very conservative debt levels, which is something we look to in some of the REITs that we own. As a result, they've been able to grow nicely. They've been able to grow and diversify away from what is their largest tenant, Magna. They still own what they call special purpose facilities leased to this car manufacturer, particularly with a concentration in Europe in a facility in Graz. And so we think there's an opportunity when that lease comes up for renewal in the next couple of years for that asset either to be revalued or sold, and will show that there's tremendous value hidden in some of these special purpose assets. So we see a lot of upside, internal growth, external growth, and this is a REIT that still trades at a discount to its net asset value. So we definitely think it's a buy.
Amin is on the line from Calgary. Amin, fire ahead, please.
Thank you. My question is on Smart REIT. Do you own it? Is the dividend safe? And I need to for a long term as an income in my portfolio. Thank you.
Thank you.
Smart Centers is a great operator of shopping centers across Canada, predominantly leased to Walmart. By virtue of that, I'd say the distribution is very safe. It is certainly a name one can hold for the long term if one is seeking income. That said, as a total return investor, we're typically looking for, and we focus a lot more on the total return and on what the price appreciation of the units can be based on typically what will be net asset value growth. Smart Centers is operating in a tougher leasing environment for all retail operators, but specifically to them, they've always enjoyed more than 98% occupancy. The portfolio is less than that today. And as a result, they have to offer incentives. And so they're seeing softer leasing spreads in order for this period of time that they're below that 98% occupancy level. So until they get back to that typical operating range, I suspect they'll probably have 2% NOI growth in 2022, 2023. And that's below some of the internal growth rates that we look for in some of the names that we own. So hence, just to answer your question, we don't own it at Vision. That said, I think it's a very safe distribution. And if you own it, I'd continue to hold it.
We're going to take a break. Andrew Moffs of Vision Capital is taking your questions on real estate stocks and REITs. You know that number, 1-855-326-6266. Greg is on the line from Edmonton. Greg, go ahead, please.
Question for Andrew. It's in regards to Melcor Real Estate Investment Trust. That's MR-UN is the ticker symbol. It's obviously in Western Canada, Alberta in particular, and with oil and Alberta picking up, I was wondering if this is a good place to invest.
Thank you.
It's a great question. At Vision, we invest both top down and bottom up. And from the top down perspective, part of what you have to look at is the geography and what are the secular themes that are affecting the bottom up, the valuations of the prospective investment. Melcor REIT, by virtue of the fact it is concentrated in Western Canada in Alberta, we are bullish on Alberta, and there's great ways to play it, and we can talk about that, particularly on the apartment side, whether it's Boardwalk REIT or even Main Street Equities. But when I look at Melcor REIT, my reservation is the sectors it's invested in. The majority of its assets are either retail or office, pretty much split 50-50. A very small percentage, I think 5-6%, is industrial warehouse. Those are two very tough sectors. The office sector particularly. Vacancy rates in Calgary are 25-30%. Probably much more than that if you actually counted the sublease space and what we call see-through buildings. So it's going to take a very long time for that sector to recover. And as a result, Melcor REIT is, it's a small cap REIT. It does trade at a discount to net asset value, but we don't see many catalysts for it to close that gap. So again, if you're looking to play that recovery in oil and in Alberta, I'd steer you towards the apartment sector.
Okay, the real estate sector getting that's interesting. It's interesting how different ways to play the rebound, but of course, as cash comes back in, investor cash into Western Canada, real estate first port of call for many. Colin in Sarnia, Ontario, go ahead, please.
Well, good afternoon, gentlemen. Thanks for taking my call. Mr. Moss, it's on Morguard, but with a twist. I get these offerings through my broker for treasury offering of convertible unsecured subordinated debentures, buy a bought deal for Morguard REIT, 5.25% convertible debentures. Are these things sort of as good as they sound, or are there things I don't understand about the convertible debentures?
Thank you.
It's a great question, and I always recommend for any investor, especially on a new offering, to read the prospectus, read the filings, understand the fine print. Every case is different, but in my experience, the majority of unsecured convertible debentures in Canada that have been issued by Canadian REITs have a feature that aren't always talked about, and that feature is what we call PIK, payment in kind. What can happen in a negative scenario where there might be a bankruptcy or a liquidation, whereas the benefit of owning debt is that you're typically senior to the equity. In this type of situation, you would be paid back in shares, meaning that debt actually converts to you in equity. So you don't have that seniority position. In many cases, I can't talk to whether or not the Morguard REIT bonds that were recently sold had that feature, but I would say a majority of them do. So it's typically not something I look to invest in unless I'm willing to own the equity. If I'm thinking of it as a bond, there's probably better yield alternatives out there.
So it's repayment in kind is the expression to look out for here, Andrew?
Correct.
That's interesting, yeah. We've got a caller from Windsor, Ontario. John, fire ahead, please.
Thank you for taking my call. I'm just wondering what you think of the offer for RioCan REIT, and do you find if it undervalues it, and do you think the minority shareholders are getting screwed? Thank you.
Thank you.
This is a very interesting transaction. Interesting in the sense of I'll preface, the majority of Canadian REIT takeovers have occurred at a premium to net asset value, to the analyst consensus NAVs, to the company's internal IFRS valuation metrics. This could be the first, or maybe one of the first, Canadian REITs to be taken over at a discount. That is obviously very disappointing to unit holders, and we've seen it expressed in the press several times so far. It's difficult as an analyst and a portfolio manager to assess this deal because there isn't enough color as to what are the portfolios that it owns being sold at. Of course, we know that the overall valuation of the REIT is being purchased at a certain share price. That said, in order for the transaction to close, certain portfolios are being sold to different counterparties. If we had a better sense of what those were, maybe we could analyze that and say, well, as a going concern, why don't we just go ahead and sell that industrial portfolio anyway, but keep Common R as a going concern? I think there's probably a little more detail that people were looking for in the management information circular that recently came out, and I think it disappointed the market.
We've got Ryan on the line from London, Ontario. Ryan, go ahead, please.
Hi, thanks, guys. Great show. Thanks for taking my call. I'd like to ask Andrew what he thinks of the current plan of arrangement with H&R to split itself up, if it's a good deal for shareholders, and if so, what would he be doing if he's a current holder of the shares?
Thanks.
It's also a great question. H&R REIT finally announced its strategic transformational plan, whereby it is spinning out its mall business in Canada into Primaris REIT, and the existing H&R REIT will then refocus its efforts predominantly on multifamily in the United States, as well as industrial, with an office portfolio that over time will be sold down. I've been asked this question many times before, and my answer is always the same. On announcement, there's no change in value. You continue as a unit holder of H&R REIT. If you are given shares of Primaris REIT, you haven't created any value. You still continue to own the two parts. What remains to be seen is, will over time the capital markets reward H&R REIT for being a more focused REIT and pursuing superior capital allocation decisions? And more importantly, will the market reward Primaris REIT, which is focused on malls, with a good cost of capital? Sitting here today, I could tell you that at least the mall side will be challenging in speaking to other market participants. It doesn't seem to be a big bid in the market for that type of real estate, but I think the track record needs to be seen, and if they can operate well, perhaps there will be a buyer of that type of REIT. So I think it's certainly a hold. I think there isn't big enough discounts in net asset value to get you through the transaction, and the market will digest as unit holders receive that Primaris REIT, and perhaps there's probably some good opportunities post that distribution.
We're going to take a look at Andrew's past picks after this. He had two ideas in residential REITs, and both are up. That's next. Andrew was on our show November 10th of last year. Your first idea was BSR REIT. Total return, 60%.
Yeah, we're pretty pleased with that. We continue to recommend BSR REIT. This is a great little company, focused entirely on mid-market, Sunbelt apartment assets, focused Dallas, Houston, Austin, Texas, with a portfolio also as well as in Oklahoma City. They have done a tremendous job on capital allocation. Since they've gone public, they have sold $760 million of assets, and they've purchased $1.1 billion of assets. In doing so, they sold assets that were 31 years old, bought assets that were 6 years old, and now they have a new portfolio that has tremendous internal operating potential. So if you just looked at what they did in October, they were signing new leases over 22% rent growth, and renewals at 6%. So a blended 12% internal growth rate is pretty attractive when you're operating at 96% occupancy. In the year alone, they've had over 40% net asset value growth as a result. So we think this is a high growth company focused in the right markets, the sweet spot in terms of the rental market in the United States, listed on the TSX, trading at a discount. So we continue to recommend it.
This time it's a real estate equity, Tricon Residential, up 60% as well.
So again, mid-market Sunbelt strategy in Tricon. They have a little different spin. They focus on single-family rental homes, which is a sector we really like at Vision. Again, here, they are benefiting from what we talked about at the outset, inflation. They're seeing 21% new lease growth rates and 5% on renewals. The big catalyst for Tricon occurred in October. They executed an IPO on the New York Stock Exchange, bringing in more capital to the company, as well as obviously expanding its investor base by listing on the NYSE. As a result, this company can now acquire, call it 50,000 homes over the next 3 years. So you couple this great internal growth picture with a great external growth picture. We're very bullish on Tricon, still sitting here today, even despite that run.
And then you had another residential idea for your final call, Canadian Apartment Properties. And of course, that's a favorite of so many institutions.
Yeah, I mean, and you think back to a year ago, the thought process was everyone has to live somewhere, and that still remains the case. So hence we went with 3 residential names. Canadian Apartment REIT is the largest publicly traded REIT in Canada, focused on apartments. And what they have proven throughout the pandemic is their resilience. Their portfolio's, I think, 98.4% occupied. The operating growth has been a bit more muted this year, and then that makes a lot of sense. Borders had been closed, have continued to be closed to a certain extent, and the apartment business in Canada is really predicated on new people, new Canadians coming to the country. So as we see immigration continue and peak in next year into 23 and into 24, we think we'll see pricing power return with full force to Canadian Apartment REIT. And you throw on top of that, what we see is there's some hidden upside in this REIT, given all the land that they own. I think they have over 10,000 zoned units that they could build today. And you think about where land prices have gone. So we think this is a great REIT, and we continue to own it.
We're going to be back with Andrew Moffs, Senior VP and Portfolio Manager at Vision Capital, and he'll take your tweets, calls and emails on real estate stocks. 1-855-326-6266. Peter is on the line from Vancouver. Go ahead, Peter.
Oh, great show. Great host. Andy, how are your 2 wonderful dogs?
As bad as ever, but they're glad the snow is back anyway. Thanks, Peter.
Okay, and the great Andy Moss, the REIT guru, what great topics you have. So may I ask your expert opinion on Dream Industrial REIT, Thank you.
Thank you.
Andrew the Great.
Thanks very much. Dream Industrial REIT is a buy. We own it in our funds. It is focused on industrial warehouse assets in Europe, Canada, and the United States. They've shifted their exposure over the past year with a sizable expansion into Europe. And they've done so via creating a new fund in the United States and contributing their assets into them. What we like about this REIT is that it has both this interesting upside in terms of external growth. Now having this U.S. Fund, they can earn fees on that, and that fund can grow quite quickly without having the REIT use a lot of capital. At the same time, their portfolio in Canada is very well positioned. They have a big concentration here in the GTA as well as in Montreal, both the two tightest markets in Canada in terms of supply and demand. We think there's, we're very positive, as I mentioned earlier when we talked about Granite, on Europe, as market rents for industrial continue to have a large runway ahead of them. The units trade at a discount to net asset value, have a nice distribution yield. So for us, this continues to be a name that we own.
Okay, you're sticking with that one. We have Ed calling from London, Ontario. Go ahead, Ed.
Thank you for taking my call. I'm phoning up on NWH. Could I get an idea on that one? Thank you.
Northwest Health Properties.
That's correct, yeah.
Thanks.
So Northwest Health focuses on medical facilities globally. Here in Canada, they have a portfolio of medical office buildings. In Brazil, they operate hospitals. In Australia, a blend, as well as they have portfolios in Europe and the United Kingdom. Recently the market was very focused on its expansion in Australia. They were trying to buy another operator of assets, and the market was very excited about that possibility in terms of the earnings profile of what that could bring. It looks like that is not going to occur, and as a result, the units did trade off. Northwest is just a stable operator, trades at a premium to net asset value. We tend to look at names that trade at a discount to net asset value. The yield is safe. They do suffer from a bit of volatility in terms of currency, in terms of, operating in all those different jurisdictions. Sometimes you have a mismatch in terms of the Canadian distribution that you have to pay out versus the income you receive. And if you have, for example, the Brazilian real oscillating, that does put a little bit of volatility into earnings. But all that said, I think Northwest is in a good shape today. They continue to grow nicely, and in order to fund that growth, they do come to the market from time to time with equity. So that's usually a place where one can look to buy more units.
Okay, thank you very much for that question. We have Jordan calling from Calgary. Go ahead, Jordan.
Hi there. Good morning. Thanks for taking my call.
Pleasure.
My question's about Duke Realty Corporation. The stock has increased about 25% in the past 60 days. Would you be a buyer at these levels, or is there potentially a better buying opportunity maybe sometime in the future? Thanks for your time, and I'll listen to your response.
Yeah, it's a tough question to answer. We really like Duke Realty. This is a stock that we've owned from time to time in our funds. It's a large REIT at this point. I think it's 22 billion market cap. So it's one of these where it's in that interesting sweet spot where we can't judge if it's too big to be taken over by private equity or just small enough. It is a great operator of industrial assets, a pure play in the United States in terms of assets that are typically modern logistics, facilitate more e-commerce activity given the large size of their assets that they own. Sitting here today, it's hard to argue that it's cheap. It trades at an implied cap rate of 3.2%, and that's typically where assets trade in the private market. We would definitely look for a pullback. That's what we do at Vision. Whenever a high-quality name like this does pull back, we look to purchase it if we see value versus the private market. And I would argue that in the industrial warehouse space, the private market values will continue to increase at least over the next 12 months, if not for sure longer, given the runway we see for rent growth.
We have a caller from Ottawa, Am. Go ahead, Am.
Hi, Andy. Hi, Andrew. Thanks so much for taking my call. Andrew, can I get your opinion and recommendations for a long-term hold in my RSP for Digital Realty or other similar investments in companies that are building out data centers versus REITs like American Tower, SBA Communications that are building out infrastructure for G5? Also, how does the rising interest rate environment affect the risks over the next, say, 5 years or so?
Thank you.
Thank you very much, and I look forward to your answer. Bye-bye.
Okay, great. So Digital Realty Trust, ticker is DLR in the United States, $47 billion market cap REIT. It's Big Daddy in the data center space, and it's the original data center REIT. This sector, the data center sector, has benefited, of course, lately from all the activity people are doing both online, but more importantly on their mobile devices. And the interconnection between different providers at these facilities is where digital it creates value. And so we think it is from a top-down perspective, it's a really great sector to be in the data center space. You're seeing a lot of activity in the private market, a lot of privatizations of data centers currently. The smaller data center REITs are being taken out. What's interesting, what the caller asked was American Tower, would you favor data centers over towers? What's interesting is you're about to see the convergence of the two, where there is a synergy for having a data center at the base of a cell tower, given exactly what I talked about. If all that data is being transferred over mobile devices, wouldn't it be great to have the data center at the foot of the antenna that's receiving all that frequency? So you've actually seen American Tower enter the space now with a takeover of one of the data center REITs. All that being said, the sector does trade at a premium to net asset value. A lot of that growth is built into the stocks. And as they get larger, it is much more difficult for these REITs to grow accretively and find the next acquisition. So I expect over the next 5 years, you will see that convergence between infrastructure assets, between data centers and towers, generally speaking.
We'll be back with... Sorry, Andrew. We'll be back with Andrew Moffs of Vision Capital, taking your questions on real estate stocks and REITs. 1-855-326-6266. We've got Gino on the line. Go ahead, Gino, please.
Thank you for taking my call, gentlemen. My question is about RioCan. I picked up a position in the summer of 2020, and I watched it trade sideways for most of that year until the fall. And now it's doing the same thing, and I'm wondering if this is cyclical, and I'm wondering what his outlook on the stock is. I'll hang up and listen. Thank you.
Thanks.
I'm positive on RioCan here. It's trading at a discount to net asset value at a time where we've just started to see a turn in their prospects in terms of the leasing environment. They've done a very good job in terms of their collection rates. I mean, that was part of the hesitation by the market a year ago. That's all everyone could talk about was, who are you collecting your rents from and how much? Well, that's really subsided, and rent collections are now 98%, and their in-place occupancy continues to improve. What I've been really impressed with RioCan has been what I'd call disciplined capital allocation. They've done a great job of hitting the bid in the private market and selling assets to reallocate to other resources, and whether they have an NCIB in place, they could buy back units should they choose, or they could invest in their development pipeline, of which they have a substantial one. So I'm positive on RioCan. It seems like they're at a good spot currently.
Okay, we have another caller from Oakville, Ontario. Steve, go ahead, please.
Hello, Andrew. Mr. Moffs, I was wondering if you would comment on WPT Industrial REIT now that Blackstone has taken their position. But can you look into your crystal ball and tell me what's going to happen there?
Sorry, Steve, can you just clarify? So it was taken over by Blackstone. What was your question again? My question was, what's its future now? Is it still listed? Can you still buy it? Is it a good investment? Obviously, Blackstone likes it, but where does the individual investor go from here? Thanks. Yeah. Now, as far as I can see, it stopped trading in October. Andrew, maybe you can clarify that for me.
Yeah, actually, it's kind of fun. Back in July, I think it was July 29th, I was on this show and I recommended WPT Industrial REIT. And just a few days later, on August 9th, Blackstone came along and made an announcement that it was purchasing WPT REIT at what was a 32% premium to the consensus net asset value. What it shows is that there's a big bid in the market for industrial assets, a big bid generally for high producing real estate. And so the likes of Blackstone, the likes of Brookfield will continue to look at the public markets, and hence we remain bullish in terms of the valuations of some of these publicly traded REITs.
Yeah, I mean, we're going to need more and more warehouses, I suppose. I saw one story a while ago that we may start seeing smaller warehouses in suburban neighborhoods, maybe even taking over malls or space in malls so they can get the goods even faster to us.
Yeah, anywhere where exactly that, you can reduce the last mile to make it more efficient. Warehouse space will, you'll find it. One thing to always keep in mind, whether it's trying to build a larger facility at a mall, for example, is that you don't typically have the great parking and trading radius that you need for a truck of these sizes, that for goods to come in and out. And plus, typically the zoning is more difficult. Locals don't typically love trucks coming through their neighborhood, and you find high quality shopping centers at Main and Main. So yes, industrial warehouse, you typically do need to be creative in terms of where you can put these facilities.
Thanks for that question, Steve. We've got Mark calling from Cochrane, Ontario. Go ahead, please, Mark.
Yes, my question is on INO, Innovalis Real Estate. The dividend payout is around 8.5%, and I'm wondering if it's sustainable or not. Your opinion, please. Thank you.
Thank you.
So this has been a difficult REIT to own in that it hasn't had a chance to grow. It's had fits and starts and went through a bit of a transformational plan, yet came out the other end and didn't sell the REIT. Some of the market participants had hoped that would be the case. Sitting here today, it's a small cap, high distribution yield, as you mentioned. If you look at estimates, it looks like they, either pay out all their cash flow or overpay their cash flow. We'd like, generally speaking, we were positive at one point in terms of the European commercial prospects. That's what they focus on. They own 15 properties in France and Germany. Today, it's a much tougher environment post the pandemic. So it's like I said, it's a REIT that's had a tough time growing. Its internal growth prospects aren't as great as they once were. And so the cash flow is right now paying the distribution, but not a name that we own in our portfolio today.
Okay, we'll squeeze in one or two more calls and questions. An email from Kevin here, interested in the U.S. housing sector in view of labor shortages and supply backups, and what he says is a recent shrinking of housing starts. What's your view of the U.S. housing sector?
Yeah, it's a very interesting sector. This is obviously a sector that's very seasonal. But what we're noticing lately is that some of those seasonal factors are not occurring. So what do I mean? If you looked at, home sales over the past month, where you have in the United States, where you have this holiday period going into Thanksgiving, you've seen traffic up. So what does that mean? I think people are out there looking to buy a home ahead of mortgage rates going higher or ahead of apartment rents going higher. All that's translated to is very low inventories. So the big wild card, the big question is, what will happen in 2022? What will be the volume? And if volume can either be at or above this year's levels, I think the stocks look cheap. Typically, home builders trade anywhere from 7 to 15 times earnings. They trade on average 6 times earnings today. So the market is already on this theme of there should be a slowdown. Some of what we're seeing is that sure, there's been a reduction because of the supply chain issues. There's been an extended timeline in terms of home deliveries, but maybe it's been 2 weeks and the market's absorbed it. If that remains the case and we see volumes tick up next year, I think there could be a lot of upside in U.S. housing once again.
Right. I mean, one way to play it would be the XHB, the Home Builders ETF, and that one has been moving up pretty steadily. And that's XHB. I think that's the one I'm looking for. I can't see the full name. This might be a US listed one I'm thinking of. Anyway.
Yeah, you're thinking of XHB in the United States. I think this one is a Canadian one.
It is, yeah. So it should be XHB in the United States. Okay. We are going to be back with Andrew Moffs. We're talking real estate. We'll straight after the break, we'll get some more ideas in the property sector. The Alberta landlord.
Right. So I alluded to this earlier. We are bullish on Alberta. If you look at the province, next year we expect the unemployment rate to be lower than it was pre-COVID, which is a pretty remarkable thing. And in the face of higher oil prices, but more importantly, a more diversified economy, I think Alberta is a winner next year. Boardwalk REIT, if I could think of a stock where you could find that has the lowest multiple, yet the highest earnings growth, that's always a powerful combination. And so that's what we see in Boardwalk. When we look at the valuation of the REIT in real estate parlance, it trades at the highest cap rate in its sector, which is the going in yield. The higher the cap rate, lower the value, the lower the cap rate, the higher the value. We think if you were to do two things, one, eliminate concessions. That's what they've had to provide historically in Edmonton and Calgary to lease up their assets, and they're on the path to eliminating them fully in Calgary and Edmonton. If we do that and we lease up a bit more space, which they are already on the road to do, we see a unit price substantially higher than the current one at a time where the private market value is much higher than the unit price. So we're very bullish on Boardwalk. We think it's worth anywhere from $75 to $90 if they can remove these concessions and lease up space.
Phillips Edison and Company, PECO, and the NASDAQ. What are they all about?
So this is a REIT that went public in July. They went public at $28. It's currently trading around 32 and change. We bought on the IPO. We continue to own it because we see a lot of value in this REIT. They focus on Sunbelt, grocery-anchored shopping centers, 100% in the suburbs. They either have the number one or number two grocer at every one of their centers, and these are smaller centers. What's interesting about this space, first of all, I talk about the internal growth. They've had better internal growth than any of their peers, and they continue to do so in this past quarter. But what's interesting is we're seeing price discovery in the private markets. Blackstone recently re-entered the shopping center space in the U.S., paid a 5% cap rate for B-plus assets that were leased to Publix. PECO is actually Publix's largest landlord. This REIT trades at more of a 6.5 implied cap rate. So we see this trading at a big discount to net asset value in a space that is safe and with great internal prospects.
We're tight for time, Andrew. I'm sorry. IntraRent REIT. Why do you like this one?
Multifamily apartments in Canada, concentration in the GTA, Montreal, Ottawa, and now Vancouver. Big push in occupancy in the third quarter. They're now set up for low double-digit growth next year, trading at a discount to net asset value.
Concise as ever. Thank you very much, Andrew, for joining us.
Thank you.
Andrew Moffs of Vision Capital.